Friends, welcome to the second video on Learn Stock Market from Scratch series by the Wall Street School. I hope you have gone through the first video in which we have discussed the basic terminologies used in the stock markets. In case not, I would suggest you to pause, watch the first video and then come back to this video. Now, to further accentuate our journey for stock market learning, we have to understand the meaning and importance of three financial statements: income statement, cash flows, and the balance sheet. Because all the calculation onwards will be basis these financial statements, so we got to understand them in detail. Since all the three financial statements are interconnected, you can't afford to miss any part of this video. So let's get started with this video. Friends, welcome to this video. Now, there was a study done by Motilal Oswal in the wealth creation study. They come out with the wealth creation study every year. It was very interesting. So there were around 3,440 companies which were listed in BSE, out of which 594 companies are not listed. 209 companies have a stock price falling below 90%, and 169 their stock price has fallen from 80% to 90%, and 132 companies whose stock price has fallen from 70 to 80%. So in total, 32% companies have eroded wealth out of the total 3,440 companies, despite the fact that BSE grew at a CAGR of 12.7%. This is not possible. So that is the reason why analyzing the financial statements of companies is perhaps the most critical thing before we take an investment decision. So in this video, we're going to learn and try to comprehend the three financial statements. The income statement, which is nothing but it states how the company has performed over a period of time. It reports whether the company is in profits or losses, the gross profits, the operating profits, and the net profits. Second, the balance sheet. Now, with respect to the balance sheet, it gives a snapshot of the company's financial position at a given point of time, showing what a company owns, what it owes, and what is left for the owners. And the third one, the total assets must be equal to the sum of total of liabilities and equity. The third one are my cash flow statements. Now, with respect to the cash flows, it paints the picture of a company's financial status and it reports the company's cash movements during the period, separating them into operating, into investing, and financing activities. Okay. Now, let's try to understand the income statement first. What happens with an income statement? This is a broad level format for any income statement. I have my revenues, my sales. From my sales, I subtract my cost of goods sold, I get my gross profit. From gross profit, I subtract my selling, general, and administrative expenses. I get my EBITDA, my earnings before interest, tax, depreciation, and amortization. From EBITDA, I subtract my depreciation. I get my EBIT, my earnings before interest and tax. From EBIT, I subtract my interest expense. I get my profit before tax. From profit before tax, I subtract my income tax. I get my net profit. This net profit is meant for the equity holders. From this net profit, there are two treatments possible. One, either I pay dividends or I add it as part of my reserves in my balance sheet. This is a broad level income statement, irrespective of whichever company, whichever sector it is. So it represents, it gives a snapshot of the performance of a company over a period of time, year, half year, quarter, whatever. It reports the revenues earned during the year, the expenses incurred for those revenues, and the resulting net profit or net losses. Simple, straightforward. How much I earned, how much did I expense out. Okay. And it measures the performance in terms of the gross profit, the operating profit, and the net profits. Now, this is a simple snapshot of Maruti's income statement. If you see it, the revenues from operations, the other income, then the expenses, and then I get my profit before tax, my tax expense, and my profit for the year, and then the other income. Same level, depends upon company to company, broad level parameters will remain the same. So this is for Maruti, this was for ITC. Again, my revenue from operations, my other income, my total income, my expenses, and all my other expenses. I get my profit before tax, my tax expense, and my profit for the year, and other income if at all there are. Okay, so company to company, broad level skeleton remains the same. Now, with respect to the income statement format that we've just seen, there was a second item called cost of goods sold. And I want to spend a bit of time trying to discuss this cost of goods sold with you. It could be for the wholesalers or for the retailers or for the manufacturers. So for the wholesalers, it is the amount paid for the inventory, and for the manufacturer, it is the sum of the raw materials, the direct labor, production overheads incurred to manufacture the company's products. This gives me my gross profit. Now this gross profit could increase over time or it could decrease over time. Now, if it is increasing over time, it will suggest that the company has pricing power due to competitive advance relative to the competitors. And if it is decreasing over time, it may be because of the pricing pressure from low-cost competitors. Or it could be that the company is playing on volumes with low margins and may be willing to work on a lower operating cost. So depending upon company to company, as per this strategy, that is how it is. Either it is increasing over a period of time and it is decreasing over a period of time. Now, let's take some example of one company. This is MRF Tires. Now, MRF, it's into tire business and their main raw material is rubber. That is what is required for making tires. So if I see their annual report of 2016, it says that the issue of raw material cost escalation, especially for natural rubber, is here to stay, which will affect the operating margins for a while in the foreseeable future. And if I see the 2019 annual report, it says that the key risks for the company are volatility in the raw material prices, currency fluctuations, which could lead to an increase in the cost of imports, and uncertainty in the OE demand. So I get to sense that companies' operating profit margins could be impacted because of raw material cost. So if I see their financial performance of MRF now I have the financials of MRF here, and this is rubber's price, and you see, so this is from 2016 till 2020, and this is from 2016 till 2020 here. You see the rubber prices have gone up like anything here in this time period, and these have then fallen down and then went up here as well. Now, if you see your sales, the sales of the company when the rubber prices were up in this year, my sales was growing at just 0.3%, and when the prices went down, the next year my sales grew by 11% and then 7%. This year when the rubber prices have gone up, my sales have grown by just 1.1%, and that's it. Now let me take another example, another company here, which is Relaxo Footwear. Now they make rubber chappals, so for them also a key ingredient is rubber. Now you see this, with respect to MRF, I can clearly see that the operating profit margins of the company are slightly going down over a period of time. Okay, and when the rubber prices have gone up, this has remained static, and when the rubber prices have gone down, this has grown up, but my margins are going down. So 19%, 15%, 14%, and 14%. This is MRF for you. Reverse the situation. Let's take a Relaxo Footwear. Again, key raw material is rubber. Now let's talk of Relaxo Footwear financial performance with the rubber price material, raw material prices. Again, the same rubber here, and it goes down. You see the sales growth. Sales, there was a degrowth which was happening here for Relaxo Footwears because the rubber prices went up. And then when it came down, the sales went up, and the sales went up. And then when it went up, the sales went down. However, you talk of their operating profit margins for Relaxo Footwear. So this is Relaxo Footwear for you. So you see The sales have, when the prices have gone up, now you see the financials here. This has gone down, this has gone down, this has gone up, this has gone up, and this has gone slightly up because the prices have gone up. However, you talk of the operating profit margins. The operating profit margins here, these have either become better or these have been steady here. This means two different companies, two different industries, but sort of similar raw material. This clearly reflects that the operating profit margins of Relaxo footwear are not vulnerable to the movement in the raw material prices, whereas that was not the case with MRF tires. And you see this, the sales were growing at a CAGR of 10% every year. However, their operating profits was growing at 14% and net profits was growing at 17%. So their operating profit is growing at a much higher rate than the sales growth. That shows the company has been able to get its profitability better and make their margins better as well. This is something which I have been able to gauge from the income statement. Same raw material, different industries, but one company's margins, operating profit margins, OPM is operating profit margins, this is getting better. In case of MRF, it was getting worse, right? And that is how I gauged the income statement at a broad level. Now coming to this part, that the brand power of Relaxo footwear gives it the power to pass on the increase of the raw material prices to the end user. However, the operating margins are growing more than the sales in the last 5 years, whereas in case of MRF, the operating profit margins was getting lesser. It was reducing. So that is the inferences that you make once you read the income statements of a particular company. Now with respect to the business expenses, so if you have made sales, there will be business expenses also. There are two types of costs which will be there. One, the cost which will be capitalized. For example, you bought a machinery, you bought a plant, or the costs which will not be capitalized. For example, which will create an immediate benefit such as fuel used in the delivery vehicles. Now with respect to the capitalized cost, they will be going to my assets side of my balance sheet, and the costs which are not capitalized, they will go to the income statement over here like this. Now if they go to the asset side here, this will then be expense in terms of the depreciation and items like those. Now let me talk of the balance sheet of a company. At a broad level, this is what the balance sheet constitutes: my current liabilities, my short-term debt, creditors, total current liabilities, my long-term debt, my other current liabilities. This will give me my total liabilities, my shareholders equity. You add your reserves and surplus. From the income statement, you get your total equity and liabilities. You talk of the asset side item, you have your current assets, you have your cash, short-term investments, debtors, inventories, others. This will give you your total assets, then your property, plant, equipment, investments, other non-current assets. This will give you your total assets. Your liability side and your asset side should match. Now, Berkshire's letter to the shareholders in 1995 says that any company's level of profitability is determined by three items. One, what the assets earn. Two, what the liabilities cost. And three, the utilization of leverage, debt part. This will all is connected to understanding of the income statement and my balance sheet. Now, with respect to the balance sheet, now this is a sample balance sheet of one of the companies. So equity, shareholders funds, non-current liabilities, current liabilities, and the asset side, we have the fixed assets, the tangible assets, the intangible assets like goodwill, patents, copyrights, non-current assets, long-term loans and advances, and then the current assets, which has investments, inventories, trades, cash, and other assets. So this is a typical balance sheet you will find for most of the companies. Now, if I were to connect the income statement with the balance sheet, You see this. The sales will be reflected either in cash, or if I've made my sales in terms of my receivables. But receivables if I've not received the money or if I've not received the cash. Operating expenses will be reflected in the balance sheet in terms of inventory or trade payables. Depreciation or amortization in the income statement will be reflected as accumulated depreciation in the balance sheet. Other income as investments in the balance sheet. Interest cost as debt in the balance sheet. Profit after tax, once I have paid the dividends, the balance is my shareholders' equity added as reserves. That is how I connect the income statement with the balance sheet. Now, Charlie Munger, the partner of Warren Buffett, he says that the liabilities are always 100% good. It's the assets you have to worry about, because all the naughty works in the balance sheets are done on the asset side in terms of cooking of the books. In the stock market wizard program, we have tried to go as granular as possible with respect to each and every line item of the asset side as well as the liability side of the balance sheet. But coming to the cash flows now, there are three components of cash flows: cash flow from operations, cash flow from investing, and cash flow from financing. Now, with respect to the operating activities, that actually means the actual cash which has been earned by the business from its core operations. It includes the net income from the income statement. You add back depreciation and amortization because that's a non-cash item. You add back interest expense. You add back interest expense here and you subtract the interest paid here. So net, there is no impact on the cash per se, but from a nomenclature point of view, interest expense is a part of your financing cost. In the net profit, because this interest expense was already subtracted, so you're adding it back to get the real cash from operating activities. Similarly, the interest income, it is subtracted in your operating activities and it is added in your investing activities, because in the net profit, the interest income was already added. So it had increased your net profits, whereas it is not a part of your core operations. Henceforth, you subtract it here and you add it back here. And then the working capital changes. Working capital is nothing but my current assets minus my current liabilities. An increase in my working capital will lead to a fall in my cash flows, cash flow from operations, and vice versa. So this is what if I total this up, I get my total cash from operating activities. Then my cash from investing activities, the actual investments which I have done in my business in terms of capex. So that is the capital expenditure which I have done, or the investments in joint ventures, subsidiaries, or investments purchased. And I have added the interest income which was subtracted here. So net, no impact on cash because of the interest income, because it is nullified. But from a nomenclature point of view, cash flow from investing activities will also include your interest income. Sum this up, you get your total cash flow from investing. And from cash flow from financing, there are two ways I can raise capital. One is from debt, second is from equity. So from equity raised, dividends paid, debt raised or debt repaid. If it is coming to me, if I'm raising debt, it's a plus. If I'm repaying the debt, it's a minus for me. And the interest paid, this will give me my cash flow from financing activities. So if I have the cash at the start of the year, and changes in cash during the year will be sum of the cash flow from operations plus cash flow from investing plus cash flow from financing. This is the total cash, and this will give me the closing cash balance at the end of the year, which will then move to the balance sheet. Now, out of all the financial statements, cash flows is the most powerful because it all boils down to cash. And why do I say that? Because the cash flow statements gives a clear picture of the true position of a company, because that is the real deal. How much of cash the company has been able to generate. A legitimate company has three activities: main, operating, investing, and financing. And each activity will either generate cash or it will drain out the money from the business. So the net cash flows of the company is the sum of operating, investing, and financing. So investors should specifically look at cash flow from operating activities, because When the liabilities increase, cash levels will increase and vice versa. When the assets increase, cash level will decrease and vice versa. Most companies that report profits on paper in terms of profit and loss account without backing it up with cash flows have faced bankruptcies, destroying the wealth for the shareholders. So cash flow from operations plays one of the most important part, because whatever cash I have earned from the operations is the real cash. The sales might be little fictitious. Cash cannot be. Investors and analysts focus a lot on cash flow from operations and companies know it. As a result, it does not come as a surprise that companies try to show the best possible picture of their cash flow from operations in their financial statements, but how to figure out if at all any naughty work is done, and that is where as analysts we need to have little bit of prudence and hawkeye. So I'll try to connect the income statement, the cash flows and the balance sheet so that we are able to understand them at a broad level. Now, this is sort of a tabular format which I've tried to make. So in your mind, just sort of try to frameify this in your mind so that so that you understand the connectivity. Now, with respect to the income statement and the cash flows and the balance sheet, so this is how it is. Just try to create a picture of this in your mind. So you have this, you have the income statement. You have the cash income and expenses, you have non-cash income and expenses, you earn this net income. So this net income, you either pay dividend, so the dividend goes to your cash flow from financing here, or it is added as profits in your reserves, so you show it in your shareholders fund, added as reserves, whatever you have not paid as dividends. So this goes here. Now this net income also is part of your cash from operations. So this cash flow from operations, basis this you also get cash flow from investing and cash flow from financing. Now cash flow from investing will be coming from the non-current assets like fixed assets, like machinery, like plant for which you have made investments. So if there is an increase from 100 rupees to 200 rupees from 1 year to 2 years in terms of your non-current assets, that means that 100 rupees of cash has been used in terms of investment in that particular year. So this flows from here to here like this, and your cash flow from investing will come from cash flow from financing, because you need money for making investments. That money will come either from equity or from the debt holders, right? So if you have money, you will make investments from cash flow from investing, and from cash flow from operations and investing and financing, whatever cash you have at the end of the year, that cash goes to your current assets over here. Now remember this, with respect to the balance sheet, you have your current assets, you have your non-current assets, you have your current liabilities, you have your non-current liabilities and your shareholders fund. Now remember something that you would have studied in your +1 and +2, that is that if my asset side item increases, it is a fund outflow. If my asset side item decreases, it's a fund inflow. If my liability side item increases, it's a fund inflow. And if a liability side item decreases, it's a fund outflow. Remember these rules here, because if an asset side item is increasing, that means suppose my fixed assets are increasing. That means I have paid cash to increase my fixed assets. So if that be the case, the cash will reduce either in my operations or in my investing. Similarly, if my liability side item increases, that means my debt has gone up, for example, because for example, I've taken debt, and my debt was 100 rupees and now it is 200 rupees. Now if my debt has increased, that means my my cash has been received by the firm. So if my liability has gone up, so it's a fund inflow which has happened to the firm. And if a liability has gone down, if I have paid off my debt, if I've reduced my debt, that means the fund outflow has happened in terms of a particular company. Okay, so just try to frameify this, pause this video, keep this in your mind, and this will help you try to connect the income statement, the cash flows, and the balance sheet. In the detailed stock market visit program, we have tried to elaborate on each and every line item in a much more granular detail. But I hope this stands as a good breeding ground for you to start thinking about the three financial statements. So that's it from my side for this video, and I look forward to seeing you again in the next video. I hope you have liked it. Thank you.